Hello and welcome to a brand new episode of the Wadhwani Viewpoint podcast. My name is Manali Shah, and today we have with us someone very special, someone whose association with the Wadhwani Foundation goes back many, many years. Ajay PV is the founder of a successful startup, and he's an alumnus of the National Entrepreneurship Network, a flagship initiative by the Wadhwani Foundation. We have with us Ajay today, who has been the founder of Scapic, an award winning AI startup which was acquired by Flipkart in 2020. And that led to the birth of Flipkart Camera. Flipkart Camera has enabled 3D and augmented reality experiences within the Flipkart app. With over 300 million visits, it's now one of the world's largest deployments of such a kind in a commerce platform. Ajay, welcome to the show and thank you so much for taking the time out.
Thanks, Manali. Pleasure to be here. It's always very nostalgic to be part of Wadhwani Foundation and NEN events. So happy to share my thoughts today.
Thank you. And I hear that you're a new dad. You have a 1 month old daughter. How's the experience been?
It's new. I'm discovering new things every day. It's a lot of Google search and trying to figure out why what is happening. But yeah, one of the most fulfilling and content I've felt ever in my life. So it's not the first time I've been a dad though. I have a pet
Okay.
dog. He's an English golden retriever called Google. So it's no less than having a child. But yeah, it's very different to be a human father. A father to human baby and. Yeah, go through the the new learnings that I'm going through every day. It's I'd rather say it's easy to start, run, build and sell a startup than probably raising a kid. And it's been just 1 month, so pretty excited for the adventurous ride ahead.
Wonderful. And I couldn't help but notice that you've named your golden retriever Google. Why is that? How did the name come about?
That was my wife actually. We were just looking for some names, something which is funny, and she just thought we'll name him Google. I think there is one a Tamil movie where the dog name is Google, so she picked it up from there.
Okay, great. So today's conversation is going to be all about startups and funding early stage startups. Ajay is also a mentor and an investor. He's invested in a number of startups, especially in the 3D, web chain, and AR technology space. So, Ajay, before we get down to business, would you like to talk a little bit about Flipkart Camera and what it does and the larger Flipkart Labs team that you are now leading?
Absolutely. The Flipkart Camera was born out of the Scapic acquisition. Sai and I co-founded an AR startup called Scapic in 2017. Went through the entire journey of building, pivoting, and then finally finding the product market fit with e-commerce as part of Scapic. I think it made sense for us to partner with Flipkart and get acquired around November 2020 is when that happened. For primarily two reasons. One, the technology is still a little nascent, and building a deep tech company from India is hard, and it's harder when you probably are living. We started when 2017 18 when the funding landscape was very different compared to what it has just been in the last 1 or 2 years as well. So I think the domain and the industry itself would take some more time to mature, and we thought partnering with a big company like Flipkart, we will be able to induce the new customer behavior, new customer modes uh, comparatively easily, because Flipkart is one of the largest e-commerce players in India with say more than 150 million active users, and the capital that Flipkart has and the kind of other ecosystem support from brands and sellers that we get. We can just focus on technology and trying to bring it to life rather than trying to create a market which is not fully existing. So that led to the Scapic acquisition, then leading to the birth of Flipkart Camera as a platform. So Flipkart Camera today is one of the world's largest deployment of 3D and augmented reality in a commerce platform. We have 3D and AR experiences deployed across multiple categories like furniture, large appliances like refrigerator, TVs, footwear, electronics, mobile phones, and even categories like beauty where you can try the product on yourself before you buy. The hypothesis is very simple, especially post pandemic, and this is true pre pandemic as well, but post pandemic especially, there's a new breed of online customers that have come. People like me who never
Right.
used to purchase a very high value product like furniture or a television or refrigerator are now buying those products online.
True.
People are probably post pandemic buying their first ever e-commerce product for the first time after that. Now we're talking of new, consumers who are pretty much used to buying in an offline environment now trying to buy that first time online. And we are talking about the same old 2D grid that we are offering to e-commerce users for the last 10 years now. It's the same product page with different images, the cost, the description. This is not something a usual offline consumer would relate to. So what Flipkart
Right.
Camera does is try to bridge the offline and online shopping experience by providing immersive shopping experiences through 3D and augmented reality. What if you could view the furniture exactly how it would look as if it is in front of you in your showroom through your mobile camera in your house? So you tap on your mobile camera, open the camera, tap on it. The furniture is right in front of you through augmented reality. You can go closer to it. You can go around it, see how it looks. You can put the TV on your wall and see how it looks before you buy. You can try beauty products in yourself. You can try the footwear on your feet. So a lot of personalization, size and fit, and immersive experiences is what Flipkart Camera does. This is I think one of the most innovative bets that Flipkart has taken in the last few years. Flipkart is known for innovation. It has seeded industry first concepts like cash on delivery, big billion day, and all of that. Now with
Right.
3D and AR and camera, we're pushing that boundary as well. So Flipkart Labs, I think, were recently set up and launched with a similar mindset to seed more innovative, futuristic, disruptive moonshot projects from Flipkart, like Camera. The Camera is one of the projects at Flipkart Labs. Now, Labs has picked up another focus area this year, more to look into blockchain, NFTs, Web3, metaverse. I mean, these are buzzwords that all of us must have heard, and it was hard for Flipkart to resist to not get a feet in the water there and start taking some early pilots. So we're going to focus on that, and in future there will be more futuristic and disruptive projects that will be seeded from Flipkart Labs. So imagine Flipkart Labs to be that that moonshot factory within Flipkart, which will seed very futuristic and disruptive frontier technology innovations within Flipkart.
That's incredible to know. And I think it's incredibly innovative. And kudos to you for launching something like that in India. So let's talk about startups and early stage funding. We've seen the startup ecosystem grow tremendously over the last couple of years, especially. New startups are coming out not only out of metro cities like Mumbai, Delhi, and Bangalore, but also tier two cities and smaller towns. So that's great to see the sheer number of startups and the innovation that startups are bringing to the Indian ecosystem. What are some of the trends that you've observed in early stage funding right now?
Yeah, I think I have to say that I've gone through probably two generations of early stage funding in just the last 3 years. Because when we raised the seed round of funding in 2017, the Indian seed funding landscape was very different compared to how it has completely changed. I would say very exponentially in the last couple of years itself. So a quick one about how it was before we get into what I feel the latest trends are, because I continue to participate in as angels and other early stage rounds, invest and advise startups. So although I've not raised seed round of funding in the last 1 or 2 years, I've seen and mentored a lot of startups who have done it. So pretty aware of the industry, right? And so happy to see, because Manali, today it gives me a feel of how the West was a couple of decades back. There are a lot of bold bets that the VCs are willing to take now. They're not playing the safe game.
Right.
Emerging technologies and deep tech startups are given a lot of encouragement early in the days, which is otherwise, I think 2-3 years back, as I told you, it was not very vividly the case, or either 4-5 years back when we raised the funding, right? India is a primarily consumer driven market, and any company which is, of course, tech driven but more focused on consumers is what I think used to rake in a lot of funding. But a pure technology enabler is not something that used to get a lot of encouragement. Very
True.
glad to see that landscape changing now. And the one of the trends that I see definitely these days is I wouldn't say the bar has gone low. I think sometimes people misinterpret that, oh, the bar for funding has gone low. I think the bar is still high. The opportunities, the kind of the funding vehicles that are available, the maturity with the ecosystem and the VC investor community, the risk appetite in itself is all something that has changed. The bar is still there. I think it's not easy to raise funds. It's very hard, seeing all the funding news. People sometimes misinterpret that, oh, I can just have an idea and go raise funds. I think, the Shark Tank and all of them have, I think, given a lot of glamour and hype appeal to what startups can do, but all of them do have to go through the long grind before they raise the funding. Just that opportunities are wider, the risk appetite is higher, and the maturity in terms of investing in understanding the space is much higher today. For example, if you see 2021 itself, I was baffled to know it's more than 35-36 billion dollars of funding raised by Indian startups in just 1 year, and a sizable number of those deals, in terms of absolute number, around 396 deals in 2021 were for seed stage investments, which
Right.
aggregates to say around 700 million plus dollars, right? Which means that, India is now opening up and waking up to what West used to do before, which is to give a lot of support at the early stage and breed a lot of startups which have not probably hit revenue. They're still in pre-revenue, they're still idea stage. And that is the biggest trend I see changing, especially in 2021, 2022, where the seed stage investment has grown multifold, and the opportunities that exist for them is available much more than what it was 4 or 5 years back.
Yeah, I couldn't agree more with you, Ajay. The number of deals has definitely gone up, but it doesn't mean that it's easy to get funding and that anyone can just do it. So, this leads me to my next question. What are some of the essentials or fundamentals that startup founders need to keep in mind to get seed funding for early stage startups?
Got it. Yeah. No, I think this part I don't think has much changed between 5 years back to now, and that's what I was telling. The bar is probably still high. It's just that if you had to struggle 8 months, 9 months to probably knock doors and then find that one VC who has understanding of deep tech and who has understanding of early stage risk appetite, now it's probably reduced by say 4 or 5 months. I mean, that's probably the only difference. What is required by a company or the founding founders is probably still the same. I believe, and I've learned it through my personal experience, which I didn't know when I was raising funds, but I didn't understand how early stage investors think about it. A lot of emphasis is given to the team and the founders, and not much to the idea or the way they're solving it. Because in an early stage, the companies are just such a early, in a young stage and very early stages of their cycle, that it's impossible almost to predict what would be that $1 billion idea at that stage. The company will have to definitely go through multiple pivots. They'll have to adapt themselves to market condition. They'll have to tweak some products. Some companies go through a complete overhaul of the product before they hit a product market fit. you know Product market fit is when you've got probably an annual recurring revenue and you have a
Hmm.
good traction, you have customer base, and that's when you probably raise series A round of funding. At a seed stage, you don't have product market fit, and investors are very cognizant of the fact that it will take company a couple of loops before they get to that. So the bet is mostly on the people and the team to be able to adapt to this dynamic nature of early stage companies, based on market condition, based on internal condition, based on vision changing, technological changes. Based on all of that, it's the ability of the founders and the team to steer the company towards the next stage.
Right,
And that's
right.
what I feel is very essential for a company today. The founders, need to be very, very aligned with what they're doing and how the VCs look into it. And my couple of advice to founders also is don't take every investor's feedback or every early stage investor's feedback very personally, or try to change a product because of it. Because every early stage investment, they have a thesis. The thesis is built upon domain, the ticket size, the maturity of founders, the team, and all of that, right? Geography, etc. So they have a thesis. Now, if you don't fit the thesis, that's absolutely all right. You move to another investor who probably will fit your thesis. Trying to change your entire product because they gave a feedback, because the feedback
Right.
is not on you. Actually, the feedback is on their thesis, that that you don't fit the thesis, but that's absolutely fine. So I think, coming back to the what is most essential, I think it's a good founding team,
Hmm.
and the bet on the founders. Now the founders need to be, now if you have done something in the past, right, I think then it's very, very easy to raise. You would have seen people who have built, sold companies, or taken it to IPO and then quit. It's very easy for them to raise funding after that because the credibility is there. But if you're starting up for the first time, then I
Right.
think you will have to bring that up in your early pitches on what makes you credible, right? It could be some early investments you've done, or part-time entrepreneurial stints you've taken, or basically a pedigree that you've built upon based on some credibility in your corporate jobs or other things. The second part is, of course, the problem and the solution or domain in itself. You have to understand that, if I think for people to understand what do I need to have, they need to step back and first understand how investing works itself. You give a part of equity or share in your company in return for somebody investing money, and how does that person make the money? Only if you make future rounds of funding, right? Early stage investors, they don't stick on till your IPO stage or acquisition stage. They usually get down the bus either at a series A, B, or worst case at a C stage, which means their only intention is the company should raise the next 2-3 rounds of funding. And that's probably 95% of what they look. Yes, of course, they will also look, can you go towards IPO? Can you be a billion-dollar company? Can you go towards acquisition? But most early stage investors don't stay till there. So their money is made back, ROI is made back in just 2-3 more rounds of funding. So if it is a business that needs to be investable, you need to convince and bring that domain and the problem statement and what solution you're offering in a manner which convinces the early stage investor that, okay, this is a long pole, right? It requires multiple stages of funding, and it is not something where I take $500,000 and then I am absolutely bootstrapped after that. I don't need to raise funding at all. In that case, then it's you can still, go raise seed round of funding, but it's not very glamorous to early stage investors because they need to wait till probably your IPO stage to get the money back, right? So you need to
Right.
ensure that your company is investable and fund worthy. And as I told, the problem statement that you're trying to solve and how you're trying to solve the problem, very important on, and that, and also the domain in which you're solving. Because depending on the domain you're solving, it could be health tech, retail, AI, ML, or a B2B SaaS solution. Depending on that, there are different profiles of investor that you need to be talking to as well. The third and last I would say is, it's not mandatory. I mean, these days probably it's not becoming very mandatory, but nothing like having it, because it's not just about raising funding. Because early stage investment is probably where you tend to lose a lot of equity and control of the company as well, and undervalue it unnecessarily. So if you want to regain certain terms of the deal, it's not just about raising money, but raising it at good terms for the founders, keeping future in mind. Then you probably, it's good if you have some early POCs, some revenues coming in. It
Mm-hmm.
may not be a full grown product revenue, but you have done some services which is hybrid of product and services, some early validation of you deploying your product with somebody else and then making some revenues. Worst case, having some letter of intents at least, so that you know that, hey,
Right.
I am not going to experiment and start my journey after I raise money from you. I have certain groundwork done already, and once I take money from you, I will be able to deploy them. So that gives a lot of comfort to the early stage investors, which increases your chances of raising seed stage funding, and most importantly, it will help you negotiate better terms with the seed stage investor.
That's super helpful. So let's say that a young startup founder has the team in place, has the business plan in place. Now, how should they go about creating a pitch deck that is investable and attractive to early stage investors?
I think that you know founders will find 1,000 articles online on how to seed stage. But I mean, Y Combinator keeps sharing a lot of seeds. Into these days, I think it's become a fancy thing to share the deck which raised $1 million seed round and all of that. So I'm sure, I think there are many references that you can find. I think what I can at least clarify is the myth which might exist is there is a specific template in which you need to do. Absolutely not. When we raised funding, there was no template that we followed, like business plan, opportunity, SWOT analysis, competition, and all of that. Although there were parts of it somewhere and maybe in appendix, I think you need to be a good storyteller, right? At the end of the day, as an early stage a founder who's trying to raise early stage funding, you need to be a good storyteller, right? And in a medium like us, which was more augmented reality and virtual reality, which is a lot more of imagination, we felt, it is our duty to take our potential investors on a dreamland, on a journey of virtual reality, and then convey our product pitch through that. We couldn't make it boring, because it kind of comes out in the DNA that how will I build a creative AR VR company if my deck is like a corporate slide with the 10 template slides. So, and that absolutely worked. In fact, that was one of our pitches went so well that although a lot of blue chip funds felt that we are at a very early stage, everybody had one common comment that this is so beautiful. You guys are amazing storytellers. You have probably the best pitch deck, and you are probably trying to solve the right way. Just that you're too early for us, and that's why blue chip investors never invested in us at early stage, and they don't also, right? Blue chip, it's too early for these days. Of course, you have separate funds and vehicles set up by blue chip funds just to focus on early stage, but we're talking about 5 years back when that probably majority didn't exist. So I just want to, I think, clarify that. I hope that's clear to everyone that you don't need a specific template, right? It's about you asking for money in exchange of equity in a company and convincing that person that you are going to make 3x, 4x out of this in the next few years. And creativity is totally up to you on how you want to convince it. But of course, there are standard 90% of the times things that work, which a VC would look forward to as well, which I'll just probably list and tell, right? These again, these are not fully mandatory that it needs to be in the same order or all of it needs to be there. Feel free to, I think, edit based on how you want to tell your story. But I think there are certain things I have felt based on, I've done probably 100 plus pitches as part of a seed range and then Series A, which we didn't end up taking and then instead got acquired. On what I think is something that essentially is required as part of your storytelling. One is, I think, a clear articulation of problem statement and how you're solving it. I think this is 25% of your entire pitch. Sometimes I've seen founders pitching to VCs, and at the end of 1 hour, 45-minute pitch, there's no still clarity on what problem you're trying to solve and how are you trying to solve it. So very clear articulation of problem statement and how you're trying to solve. And in addition to it, what is your USP, right? It's not just, okay, traffic is a problem in Bangalore, here's how I'm going to solve it. I mean, that everybody could be solving it as well. What is that makes you and your product stand out, and what is that uniquely differentiating your product? That's something that again needs to be called out. You need to have a clear vision. As I told, it's a lot about the ability of the founder to be able to take it till the logical end and being able to navigate all uncertainties that exist as part of startup venture building. So I think you need to have a clear vision, and it's okay. Nobody will hold you on record for it that, oh, your vision was this and now you're changing it. But you need to have a clear vision that these are the assumptions. And if the landscape, the environment, the market, the team, the technology plays this way, then this is how the vision of the company is, and this is how I'll build a $1 billion company. It's very important you have that. It's absolutely fine whether you end up changing it later, but you should have that vision that in a controlled environment, this is how I'm going to build the company towards a logical conclusion. Few things like, standard slides like competition, because I think sometimes founders think that, oh, putting competition means I am inviting myself competition. Will it be a negative thing for investors? Absolutely not. In fact, if you think that you're the only one doing something and nobody else is doing in the entire world, 90% chances you will not get invested, because VCs don't want to take such a risk. They want to play a game where, there are 2-3 players, there are 4-5 players,
Right.
and just try to figure out how you're differentiating from them. Sometimes you may see two similar companies being pitted against each other, both raising massive venture capital, which is also common, right? Uh, Sorry, Manali, am I audible? Okay, there was some
Yeah,
network
I
issue.
could hear. Yeah, it's fine. It's fine. Yeah.
Okay, so I think having competition slide is absolutely fine. In fact, you should be transparent and openly call out in your domain who are the other competitors, but also call out what makes you different. If there's no difference between you and them, then there's no point of raising fund. But maybe it could be that, they are in US geography, I'm in India geography. That absolutely fine. But call out what you're differentiating from how you're differentiating from the competition. Opportunity, because VCs, again, as I said, you don't know investable. So how big the opportunity is, how big the market, the TAM, SAM, the total addressable market, the serviceable addressable market, which gives a kind of indication to an investor that, okay, this person, the founder has done their homework to understand it's a big enough opportunity, and the value that the startup can take out of the entire opportunity is also high enough. And that's what makes their eye pop that, okay, it's a big enough opportunity for me to not let go of. Then the team, of course, as I told, early stage investments is mostly about the team. If the team is right, you can absolutely change your idea and build still a unicorn without, having to fret about it. But if you have a bad team, then even it's $1 billion idea on day one, you will not be able to value it at even $10 million if you don't have the right team. So couple of founders or one founder or three founders, whatever it is, the good founding team, along with the founders core team, is what I think is very essential. and you should call that out on how you have built that rock solid core team as well. Business plan. Sometimes people think that it's not necessary for me to put a business plan. You're right. I think there is no practicality if you raise the first $500,000, $1 million, because the business plan you put on how the expenses and revenues will come, 80% won't work out that way, right? It's all going to change. And trust me, VCs know about it as well. Investors know about this as well. The intention is not to put something which they will match every month on month and say, why are you deviating? The intention is to see what is your thought process currently if you were to deploy this fund. They agree that it is dynamic, they understand that it's going to change, but it cannot be a blank slate at which you can start with after you raise the fund. They want to know how would you deploy the fund and how frugal you are, how smart you are, because a base understanding of finances is essential, although you are a tech founder, to make a company successful. And you have seen a lot of companies not succeeding because a base financial knowledge of founder is probably weak. So it's just to understand, do you understand P&L? Do you understand EBITDA? Do you understand gross versus net revenues? Do you understand monthly burn? Do you understand recurring revenues? And at the end of the day, what is the runway that a startup will have? That's something as a founder you need to know, because if you're just focusing on building the product and not even aware of the runway, there are chances you will hit a dead end and you don't have enough funds in the company. You're not prepared enough to raise the next rounds. So it's good to put a proper business plan which calls out how you will deploy these funds and what is the runway that you have, say 12 months, 18 months, and what will you do with these funds, right? I think that's important. Broadly, this is what I would feel, Manali, is good enough. As I told,
Yeah.
this coupled with your uniqueness of bringing the story out is going to probably, hopefully, land you a check at a seed stage. You can, of course, add additional slides like a SWOT analysis, risk mitigation, and all of it. My suggestion is keep it to the point, short,
Right.
have all of these slides in appendix, and depending on investors to investor, depending on fund to fund, there are different questions and focus areas they
Right.
have, and you can always bring that up as an appendix whenever you want to.
Right. I hope all the young founders that are tuning in are taking notes. So you need to have the right team, the right product, and the business plan and the deck, as Ajay just shared. So, lastly, say you have all that in place. How and where do young founders approach private investors for seed funding?
Yeah, I think we didn't know that. I didn't know how to approach. See, because this is the first time I was raising a seed stage funding back in 2017. I'll tell you how we went about it, and probably there are at least 7, 8 other opportunities that exist in India today. In terms of opportunity, these are broad domain, pockets of opportunity, and each of them has hundreds and 200s of opportunities within them as well. What we did ideally is, we had appointed a banker, and you wouldn't hear of somebody appointing a banker at a seed stage, but we had an early stage banker who were starting their journey as a investment banking. And they said, they had good connections with funds, and they said, hey, we will help you raise funds. So we had a banker who actually helped us connect with potential investors, angel investors, and VCs included, and we used them to raise the funding. So that is one way. But of course, these days, 99% nobody goes to an investment banker. And investment bankers also don't prefer to invest their time in an early stage funding, because the time it takes to raise a seed stage funding of $500,000 to $1 million, say probably from getting the first pitch deck to landing the entire money in your bank, it takes 8 months to 1 year. It's probably the same for a series A, B, C startups as well. The ROI that the banking firm gets is probably 1/10 of what you get in a higher deal. So the investment bankers also don't prefer it these days. But that's how we went about it. I'll tell you, I think there are 7 to 8 ways in which I would say the opportunities are available. And early stage founders should probably try all of it or majority of it in parallel, because you never know what will land. The first and simple and foremost is, I think before you even know where to approach, you need to understand what is the amount you're raising. Typical values that you raise in a seed stage would be, say, around $500,000, or now it has gone even $1 million is not considered. It's considered as an average seed round of funding.
Mm-hmm.
Yes, there are companies who raise 2 million, $5 million seed round of funding, but they are very rare startups. Either the founders have 2, 3 serial entrepreneurs, or it's such a massive idea that the VCs are putting big weight into it. Otherwise, the usual deal size I've come across is $500,000 to $1 million. Now, if you want something lesser than that, just $100,000, etc., there is the friends and family round that you can do, which is, before the seed. It's called as pre-seed, or, like a bootstrapping kind of investment. So you can raise 30, 40, say maximum $100,000 within your friends and family itself. And that can be at a very simple terms, or the terms can be put, postponed till the time you raise an actual round of funding as well. But it's not uncommon to see friends and family participating in your seed round of funding as well. When you stitch a seed round of fund of
Right.
500 to 1 million, you want to probably invite your friends and family as well, either directly, or most usually, as I told, they would have raised 100,000 dollars from friends and family, and then they let them participate in the same round, because they wouldn't have negotiated any terms and all that for just $100,000. Angels is definitely one other important a channel for you to raise early stage funding. Angel investors in India have grown a lot. As startups have grown, startup founders have grown, they have made a lot of wealth. And every founder, including me, would believe in giving back to the society, and believe, and also monetary, we believe that the biggest ROI that you can get out of all financial instruments in the market today is probably, startups. It's not just monetary, as I told, it's also something that gives us personal satisfaction as well. So you would see a
True.
lot of founders setting up angel funds of their own. They, in their individual capacity, most of the Series C and above startup founders today invest as angel investors. So they are probably just an email away or one LinkedIn connection away. So I think it's easy for you to find them, which I think you should do to get an angel round of funding. Now there are angel syndicates as well, like AngelList and Kickstarter and Indian Angel Network, and there are a lot of angel syndications where you don't have to go to every angel. You get one-stop access, one platform which exposes, multiple angels to you as well. So angels are very easy way for you to attract fund, which combines with crowdsourcing or crowdfunding that I told as well. And that's what AngelList and other platforms do. They crowdfund kind of from different angel investors and let you give a raise funding as a platform. The other one is accelerators and incubators. It's grown a
Right.
lot today. A lot of funds have accelerators. There are only dedicated accelerators. Government bodies have incubators. Corporate companies have accelerators set up. Depending on the domain you have, I think a lot of these corporate companies like real estate, e-commerce, Flipkart has an accelerator. Every big company out there has an accelerator, right? So accelerator is a great way for you to not just raise the early stage of funding. It gives you a lot of business access and a platform for you to prove your product worthiness in the first place as well. If you have an early stage product, how would you deploy it? Funding is one part. You then have to get potential clients, agreement, get a POC done, which is what an accelerator will help you do, right? If it's a corporate accelerator. But a lot of other accelerators not just give you money, they give you certain skills that you need as a founder as well. Probably you're struggling in hiring, the accelerator helps you get people. You need mentorship in how to prepare a go-to-market strategy, because as a tech founder, you're not too much aware of marketing and growth hack that you want to do for your GTM plan. That is something they can help with. So accelerators serve as a great way for first time entrepreneurs to not just raise money, but also get these additional benefits as well. As I told, corporate strategic funds exist as well, which you can dip into. The last, of course, is the VCs and going with the bankers or directly approaching VCs as well. As I told, a lot of blue chip funds today have dedicated a small 50 million, $100 million funds dedicated for early stage investments with a ticket size of 500 to million. And I know personally itself, I think easily 30-40% of early stage funds have come in the last 3-4 years. Right, so a lot of investors have, or venture capital VC fund managers have started funds of 50 million, $100 million checks, size, only to focus on early stage investments. They don't invest in Series A, B, and C unless, of course, it's a follow-on investment. But this is something that was not there much 5 years before, right? There are dedicated funds who only do early stage investments. You approach them. It can be either a blue chip fund setting that, but I know at least of 40 funds who do only early stage investments, and that's about it, right? So I think it's easy for you to go get access to them, and they understand early stage risk and the stage and all of that, so it's easy for you to get across them as well. The last is, I think, fellow founders. I mean, founders, one way founders itself can invest as angels, but if founders have raised funds, that's the easiest way for you to reach out to any investor or other angel funds, etc. Because more than a banker putting a word to an investor, because there's a commercial interest there, a fellow founder among their portfolio recommending a startup has a huge value. For example, if I were to go back to my investors and refer a company, they would they would probably treat it with highest priority compared to organic deals they get from their funnel. So tap into your network, see if you know first degree, second degree, any founders who have raised funds. They'll be very glad to put you in touch with investors and recommend, and also give you some free pro bono advisory on changing your pitch deck and certain things that are reasoned as well. So it's pretty exhaustive, and I know that it's easier said than done, but I've gone through it, so I can definitely vouch for it that from when I was raising seed round of funding 5 years back to now, the opportunities are much higher. The channels that I told you are much wider, and the access to these channels are much easier. So with some bit of effort, I think you should definitely be able to land a few meetings. And what happens beyond a meeting is, of course, we have spoken the last 30 minutes on how do you convert your meeting to a check. But to land a meeting, I think enough opportunities are available today in India. And I'll be surprised if somebody says we have tried for 8 months and we have not even got one meeting with a potential angel or investor, because then you have not tried at all.
Wow, that's super helpful. Very, very practical advice. I'm sure the young founders who are tuning in will find it extremely beneficial. And it's been amazing to see your journey from being a college student, a young entrepreneur as part of the National Entrepreneurship Network by the Wadhwani Foundation, to now a successful founder, investor, and mentor. Thank you once again for dedicating your time to this podcast and helping out fellow founders in the ecosystem. Thank you very much.
Absolutely, a lot left to be done, Manali. I think the journey is endless. I think I'm learning every day and continuing to probably build upon what I've done. So yeah, I think all the best to all the potential founders out there who are supercharged with a crazy idea that's going to probably change the world. So don't let anybody or anything discourage you or let you down. If you believe in an idea, you're passionate about it, you're here to run a marathon and not a sprint. I think go ahead, raise the funding, or get access to funds in different ways, and go bring your vision to life. So very excited to see how the Indian startup ecosystem will continue to grow from here. And kudos to you, I think, Wadhwani and NEN as well, for being a part of making this happen. Yeah, I think there are a lot of other factors that have contributed to Indian startup ecosystem growing. But if you ask me, I think a lot of uh, 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 acceleration and thrust was given by NEN, and it's been doing for last 12 years. And from my personal capacity as well, I wouldn't probably be an entrepreneur if NEN had not come to my college 12 years back, because I would have done my masters in US and probably settled there. So thank you for continuing to strive to build the startup and entrepreneurial ecosystem in India.
That's heartening to hear. Thank you so much. And thank you to everyone who's tuned into this episode. Stay tuned for more insightful chats. My name is Manali Shah, and I'll see you in the next one.